You know, for those of us who really obsess over the mechanics of elite businesses, certain companies just stand out. Not just for what they do, but for how ruthlessly they optimize the way they do it. Welcome to today's Explainer. We're not just running through a standard earnings update here. No, we are looking at a masterclass, a literal case study in how a true compounder fine-tunes its machine. We are diving straight into S&P Global's first quarter 2026 results. This is a business that, let's be honest, essentially taxes the global flow of capital. And as we unpack their latest data, you're going to see exactly how they're sharpening their structural advantages to just an incredibly fine edge. Let's kick things off with that top-line blowout. $4.17 billion. That is the revenue S&P Global pulled in during just the first quarter of 2026 alone. We're talking about a remarkably strong 10% year-over-year jump compared to Q1 of 2025. I mean, when you are operating at this kind of massive scale, hitting double-digit top-line growth, that is a phenomenal achievement. It instantly establishes the company as this massive, unstoppable cash engine. But look, we both know that for a true compounder, revenue is really only half the story, right? The real magic happens when you look at what actually makes it to the bottom line. 32%. That is the explosive growth in their GAAP diluted earnings per share, hitting $4.69 for the quarter. Oh, and adjusted diluted EPS? That saw a really robust 14% increase too. This right here is exactly what you want to see in a high-quality compounder. The top-line growth doesn't just, trickle down. It forcefully flows straight down to the bottom line, completely amplified by incredible operational leverage and expanding margins. So how exactly are they pulling off this level of immense profitability? Well, that brings us to part one, the core moat, focusing on margin expansion. Okay, let's dive right into this and do a bottom-up analysis to really look under the hood. Because to understand a compounding machine, you've got to look at the individual engines powering it. Just look at the sheer disparity in margins across their portfolio here. Over on the right, you've got the mobility segment sitting at a very respectable 40.2%. Now, for most companies out there, a 40% margin is literally the dream. But look at those pillars on the left. The ratings division is operating at an astronomical 65.6% margin. And the indices business? It just towers over the whole shebang at a staggering 71.3%. Indices and ratings are absolute fortresses of profitability. Seeing these numbers side by side, it plants a really important seed. If you're the management team trying to perfect this compounding machine, why on earth would you hold on to a 40% margin business when your core operations effortlessly cruise north of 70%? Keep that thought in your back pocket. But first, let's look at how they're actually defending those 70% fortresses. Moving on to part two, deepening the moat through AI integration at scale. Let's pivot our narrative for a second to how a compounder actually protects and deepens its moat. Look, in 2026, the biggest elephant in the room for data providers is AI commoditization. But S&P isn't treating AI as just some industry buzzword or an existential threat. They are deploying it as a highly strategic enhancement to their core workflows. Take a look at this prime example. They are actively evolving their flagship platform, S&P Capital IQ Pro, going from your traditional web-based desktop app into an entirely AI-native powerhouse. And they're doing this by working incredibly closely with their internal Kenjo teams. That's their specialized group focused entirely on AI-first solutions. They aren't just, slapping a chatbot onto a clunky old interface. No, they are rethinking the entire user front end and productivity tools from the ground up to amplify the value of their highly differentiated proprietary data. And they're rolling out very specific, highly targeted tools to make this happen. We're talking about things like Chat IQ, Document Intelligence, Chart Explainer, and Drift AI. Basically, S&P is developing skills to make their proprietary standards natively available right inside frontier AI platforms. The strategy here is absolutely brilliant. By seamlessly connecting their curated, hard-to-replicate financial data directly into AI workflows, they are fundamentally increasing how much people use and rely on their products every single day. And in the enterprise software world, increased sticky usage directly translates into unassailable enterprise pricing power over time. All right, part three, strategic structural sharpening, or as I like to call it, shedding the weight. This right here brings us to the absolute core of the compounder thesis. We've seen the unbelievable margins of the core data business, and we've seen how AI is building a wall around it. Now we get to the structural optimization, shedding that lower margin weight. We are watching this intentional shift from a diversified S&P to a highly specialized S&P. The company remains squarely on track with the planned spin-off of its mobility division. In fact, they've got an upcoming Mobility Global Investor Day set for May 12, 2026, over in New York City to detail the whole separation. Plus, they just announced an agreement to divest the geoscience and petroleum engineering software portfolio over in their energy division's upstream business. They expect that transaction to close in the second half of 2026 or maybe early 2027. They're literally carving away the parts of the business that dilute their ultimate financial profile. Now, dropping a business that generates a 40% margin, that might sound totally crazy to an outsider, but it makes perfect, ruthless, strategic sense when your core data, ratings, and indices engines run comfortably north of 70%. And this brilliantly illustrates why. By removing those lower margin segments, like mobility and upstream energy, S&P Global is going to emerge as a much leaner, significantly more specialized entity, one with a laser-focused concentration on the absolute highest margin corners of global finance.
Which leads us nicely into part 4, the capital return promise. Let's talk about rewarding the shareholders.
Because think about it, when a company achieves 70% margins, completely dominates its market, and sheds all those capital-intensive diversions, it generates absolute mountains of cash. And the final ultimate test of a compounder is aggressive and consistent capital allocation. $1 billion. That is the sheer volume of share repurchases S&P Global executed in just the first quarter of 2026 alone. This isn't some aspirational long-term goal. This is literally what they did in 3 months. Buying back stock at this kind of aggressive velocity, it's a massive testament to the board's confidence in their ongoing cash flow generation and their fundamental belief in this specialized structure they're building. So the crucial takeaway here is this absolute hallmark of a compounder. S&P Global now explicitly expects to return 100% or even more of its adjusted free cash flow through dividends and share repurchases in 2026. They are perfectly optimizing their capital structure to align with their operational structure. They're making sure that every single drop of value created by that 70% margin engine goes directly back to the shareholders. It really is just a beautifully constructed playbook of financial engineering and operational focus. But as we wrap up this explainer, we do have to look objectively at the structural risk this evolution creates. The transformation is incredibly powerful, yes, but it completely removes the safety net of diversification. So, the ultimate question we must leave you with today is this: can S&P Global maintain its high margin trajectory as it sheds diversified revenue streams to become a more specialized entity? Or will this cleaner structure leave it more exposed to the next regional issuance drought?